I messed up a bit. Bonds seemed so complicated at first with all the financial jargon and numbers. I felt overwhelmed and unsure where to start. But then I took a step back and realized that understanding bonds doesn't have to be difficult. It's all about breaking it down into simple, subtle, digestible pieces. I didn't realize how easy understanding bonds could be. Once you get the hang of the basics, it all starts to make sense. It's like learning a new language. At first it seems foreign, but with practice, it becomes second nature. Let's make sense of it together. We'll walk through the key concepts and terms so you can feel confident in your understanding of bonds. Whether you're a beginner or just need a refresher, this guide will help you navigate the bond market with ease. Imagine this: you lend money to a friend. They need some cash for a project and promise to pay you back with interest. This simple transaction is the essence of what a bond is. And they promise interest every year and return your money later. Then this agreement is formalized in the bond market, where governments, companies and municipalities issue bonds to raise funds for various purposes. That's basically what a bond is. A bond is like a loan you give to a government, company or city. In return, they pay you interest, called a coupon, and promise to return the full amount on a set date, known as the maturity date. A bond is like a loan you give to a government, company or city. This loan helps them fund projects, operations or other financial needs. In return, they pay you interest, called a coupon, and return the full amount on a set date. The maturity date. They pay you interest, called a coupon, and return the full amount on the set date, the maturity date. The coupon payments provide a steady stream of income, making bonds an attractive investment for those seeking stability. Some key terms. Let's break down some of the key terms you'll encounter in the bond market. Face value is the amount you get back at maturity. It's the principal amount of the bond, also known as the par value. This is the amount the issuer agrees to pay you when the bond matures. Coupon rate is the interest you earn. It's expressed as a percentage of the face value and is paid at regular intervals, typically annually or semi-annually. Yield is the bond's return, which changes with its price. The yield reflects the income you earn from the bond relative to its current price. As bond prices fluctuate, so does the yield. There are different types called government bonds, corporate bonds, municipal bonds, and international bonds. Each type has its own characteristics and risk levels. And international bonds, government bonds, are issued by national governments and are considered low risk. The corporate bonds are issued by companies and may offer higher yields but come with higher risk. Municipal bonds are issued by cities or local governments and often provide tax benefits. International bonds are issued by foreign entities and can add global diversification to your portfolio. Bonds are traded in two markets: the primary market, where they're first sold, and the secondary market, where investors trade them. Understanding these markets can help you make informed investment decisions. The primary market, where they're first sold directly from the issuer. This is where new bonds are issued and sold to investors. And the secondary market, where investors trade them. In the secondary market, bonds are bought and sold among investors, similar to how stocks are traded. Bond prices fluctuate with interest rates and economic conditions. When interest rates rise, bond prices fall, and vice versa. This inverse relationship is crucial to understand, as it impacts the value of your bond investments. When interest rates rise, bond prices fall, and vice versa. This happens because new bonds are issued with higher interest rates, making existing bonds with lower rates less attractive. Conversely, when interest rates fall, existing bonds with higher rates become more valuable. But beware of risks: interest rate risk, credit risk, inflation risk, and liquidity risk. Each of these risks can affect the performance of your bond investments. And liquidity risk, interest rate risk, is the risk that changes in interest rates will affect bond prices. Credit risk is the risk that the issuer may default on payments. Inflation risk is the risk that inflation will erode the purchasing power of your returns. Liquidity risk is the risk that you may not be able to sell your bond easily without affecting its price. So why invest in bonds? For stable income, preservation, and portfolio diversification. Bonds can provide a steady stream of income through regular interest payments, help preserve your capital by returning the face value at maturity, and diversify your investment portfolio to reduce overall risk. And portfolio diversification. By including bonds in your investment portfolio, you can balance the risk and return of your overall investments, providing stability and reducing volatility. Now, you know the basics of bonds. Happy investing. With this foundational knowledge, you're better equipped to explore the bond market and make informed investment decisions. Remember, bonds can be a valuable part of your financial strategy, offering stability and income in a well-diversified portfolio.